Welcome to Views from the North, a Canadian rates and macro podcast. This week, I'm joined by Jeff Oland, one of our Government of Canada traders. This episode is titled Consequences. I'm Ben Reitzes, and you're listening to Views from the North. Each episode, I will be joined by members of BMO's FIC sales and trading team to bring you perspectives on the Canadian rates market and the macro economy. We strive to keep the show as interactive as possible by responding directly to questions submitted by our listeners and clients. We value your feedback, so please don't hesitate to reach out with any topics you'd like to hear about. I can be found on Bloomberg or via email at benjamin.reitzes@bmo.com. That's benjamin.reitzes@bmo.com. Your input is valued and greatly appreciated. Jeff, welcome back to the show. Pleasure to have you. I brought you on today because of your fiery attitude this morning, so I picked you. I expect you to bring that same fire to the podcast today.
Well, it's there's lots to be fiery about. It's good to be back. Thanks for having me.
The only downside is now that it's 4:15 on Wednesday. We've had the Fed. It's been a long day. Seemingly every day feels like a long day because we're just waiting for the next ridiculous headline. So maybe some of that fire is a little bit gone, but maybe I'll try and rev you up. So why don't we start with inflation? It's your favorite topic. When inflation was out yesterday, there was also a lot of fire. We got the February numbers for Canada yesterday. They were wickedly hot, far higher than almost everybody thought they would be, much higher than I had in my model for sure, and it reflects underlying strength in prices, I think, and maybe we've underestimated the momentum in inflation. 6 months ago, everybody was all about, inflation's really, really low if you take out shelter. Well, guess what, people? Shelter's now the low point, and everything else is on fire. So has the Bank of Canada made a mistake here, Jeff? Have the markets made a mistake? Are we still underestimating the staying power of inflation?
There's a lot there. It's an exciting topic. I'm sure we could talk about that for the next hour, but
We won't, I promise.
I think the first point being maybe all of us who are in the rates market, but in financial markets in general, need to have another think about what causes inflation to the extent there's let's call it a basis between what is inflation is being printed by the statistical agencies and what it actually is in the real economy and how volatile that may be, how inflation interacts with the business cycle. I think the inflation has tended to be kind of a lagging indicator and tends to peak toward the end of the business cycle, or maybe even during the recession. But with all that said, core inflation by the measures that the Bank of Canada states has been now way over target for like 4 years. I remember in the fall of 22, people saying, yeah, it's just about, they're going to be way through the target now. Everything's going to come down. It's just rent, nothing else. And so now I feel like we're at the point where this is starting to hurt the credibility of the Bank of Canada because they were wrong initially in terms of the transitory, which they're in good company there, and it's understandable. But now they've loosened the policy rate so much in a period where inflation has not only never really gone through their target, but actually looks to be kind of increasing to the upside. I don't understand how, if you're an inflation targeting central bank, you can justify that under the framework in which you've been working. And so, to some extent, I feel the Bank of Canada is changing the rules of the game in the middle of the game. And I have a small amount of sympathy because I know it's a difficult period, and I know a lot of people will say, but don't you know there's a trade war? Yeah, we know there's a trade war. That doesn't change the mandate of the Bank of Canada, and in the end, they can always do an emergency cut if they need to or whatever else. And I think, just back to the original point about what it is that causes inflation, why is inflation and overnight rates 12% in Brazil and 0% in the DM? I think we're probably transitioning back to a period where maybe inflation ends up being higher for whatever the reasons are that cause inflation. And I think people have their own opinions as to what that might be. But I feel it is a very real possibility here that the Bank of Canada has made a policy error. And the last point I would make, there's not a lot of people that seem to agree with me on that. And so I have no problem having that opinion. But I think it's setting up an opportunity here in markets generally because everybody still seems to be operating under the old rules from 2010 to 2020, which is rates are going back to zero, there is no inflation, the Bank of Canada pays no price for cutting rates. Essentially there's no trade-off. There's no trade-off. The only thing that matters is getting rates lower. And I feel like that's a real consensus. to some extent, I almost think it's debatable in a trade war if you even want lower rates. I mean, yeah, of course, there's going to be some demand destruction, but if you read anything out of the currency market, what's worse, your currency getting hit 20, 30%, or you having whatever, very much higher inflation? There is something to be said for what the currency markets are telling you, which is that this trade war isn't going to escalate a lot, which is, furthers my opinion that this might end up being a mistake. So it's a long-winded answer, but the short answer is maybe all of us need to rethink what kind of regime we're in and whether or not inflation is in the same regime we were in 2010 to 2020.
Okay, three things. One, you used the word transitory, and I had to bring this up, and I was shocked today when Fed Chair Powell used the word transitory again. And I was like, how can you possibly find a new word? You made a mistake in the pandemic. You used the word transitory. You were proven dead wrong. And then you whipped it out again. And it's like, dude, you just need a better word. And I just had to say my piece there because I can't help but to shake my head. Like, what are you doing? Find a different word. Temporary, anything. It doesn't even matter. Anything different. Okay. I said my piece on that. You mentioned the Bank of Canada changing the rules of the game. They have. I mean, they started with 3 core inflation measures in 2016, and then they cut common measure in 20 or 21, whenever it was dead wrong, and it continued to be dead wrong for a while. And now they've also dumped trim, saying, well, it doesn't really reflect the basket appropriately, and so we're left with 1 core inflation metric from 3, and even then there's a little bit more focus on why don't we look at the breadth of inflation, the number of items that are higher or lower. And I mean, I guess at the end of the day that's kind of what you want to look at, kind of look at everything more broadly, but the rules have kind of changed over time, and I'm with you. I try my best not to be overly critical of the bank, just because it's a hard environment, and they're doing the best with what they have, which is very incomplete information, and having to look forward is really hard. I mean, I forecast all sorts of things. Everyone's bad at it, and that's just the way it goes, because you are going to be wrong, because there are shocks that are going to come that you cannot predict. And one of the last things you mentioned was people thinking there's no trade-off for lower rates or of moving rates to zero. And I think that's probably just an unfortunate consequence of the past 10 years. Consequences are a big part of it's a word that I use a lot personally with my children. I explain to them that actions have consequences. If you do something stupid, there will be a consequence that you may not like. And so rates going down to zero for 10 years probably wasn't the greatest idea in the history of finance. And now we're dealing with the consequences. I think the part that we're probably missing, and you're starting to see seeds of it planted elsewhere, and we're going to go here because this is a perfect segue. I love this. 2 weeks ago, I was in London, and Germany announced their massive fiscal package that was going to come. And it passed this week, 500 billion euros. 100 of that, I think, is going to green stuff. But still, I mean, you're looking at 500 billion euros in spending over, I don't remember the time period, is it 5 or 10 years, whatever it is. I think it's 5-ish years. But it's like 2+% of GDP per year in fiscal stimulus. How long until we get that here? I mean, that's the part that was missing in 2010. There was no fiscal, it was just rates. And then in the pandemic, it was all fiscal and all rates, and we knew what happened then. And now I think the bank has kind of learned a lesson, and you have to give them a little bit of credit at least in sounding as cautious as they are, because I think they know that something is going to come on the fiscal side, and if they blow their brains out on rates also, and you have fiscal, we're going to be in a world of hurt.
I mean, it's interesting, and I think we've been saying on the desk this week, or I've been saying to myself, and maybe nobody's listening, but it feels like COVID 2.0, X the QE part, at least for now, where we're going to get maybe easier monetary policy than is currently required and a big fiscal. And the fiscal in Canada, it's just like the easiest political thing you could ever do. If you're a premier right now, or you're the federal government, which that's another story, but it's such an easy thing to sell to the population. Everybody sees the headlines. Everybody's concerned about whatever. They don't even know necessarily what they're concerned about. But, the government's here to help, and I feel like there's no doubt in my mind we're going to get big fiscal announcements. And so, put that together with the Bank of Canada to the extent, and it goes back to the first point, that you think that causes inflation. There are people maybe that disagree with that notion. I think for sure when the central bank is undertaking QE and the government's doing a big fiscal, that's inflationary, especially like in COVID when there were direct transfers to the households. So none of this is for sure. And yes, there's no question everybody deserves a little bit of grace for how difficult a policy environment it is. However, it appears to me to be shaping up to another wave of inflation. And I think there are a lot of people that are saying historically you get two waves of inflation. Well, I can see why. And the big reason for me is that we didn't have a substantive conversation in the public about what caused the first round of inflation and what the trade-offs were. Fine, in some circumstances, COVID was a very difficult policy period. In some circumstances, it might be worth the trade-off to do all the things I just mentioned in order to avoid whatever you think the negative shock is. In the current environment, I think it's as yet debatable. We'll have to see in the next 6 months. Maybe in the end, I'm totally wrong about this and the Bank of Canada hasn't done enough. We'll see. And, on that point, there are two things I'd like to say. The first being, we're not running, and I think we talk about this every time I come on, but the U.S. deficit, it just cannot be overlooked. I think it's a very important, maybe the central, most important aspect in financial markets right now that people don't talk very much about. I think it's very important. Well, we're not running the same deficits they are in the U.S., and maybe to that extent, then monetary policy is required to be a little easier. So I think there's some interplay there which we need to consider, but if they come with a big fiscal, certainly, I think there's reason to believe there will end up being inflation from that. So all in all, in my mind, that is the risk. And on the second point, look, of course, if it ends up being that this trade war isn't as substantial as people expect and it's required, then the Bank of Canada should trade out of it and maybe consider hiking rates, which I would say virtually nobody thinks is a possibility. Which, on the final point, would say, do I think in a steady state environment, this level of rates is a problem for the Canadian economy? Probably. But our biggest trading partner is running a 7% deficit, which is mostly consumption. Social Security, Medicare, Medicaid, those are consumption items. And we're, I think, quote unquote, the beneficiary of that, or it's at least supporting our growth and inflation. So nothing's in a vacuum, and maybe that's what's causing our inflation to be higher than it would be otherwise in isolation. So it's important. This is important that the Bank of Canada gets this right, because there's nothing more destabilizing to society, and you're already seeing it in terms of some of the split on opinion between young and old, than above target inflation. We have it. In fact, some people say 2% is too high. The target should be 0. But regardless, there was a target, there were rules of the game that were established, and they're not playing by them right now. So maybe we have to have a recession. Maybe we have to have some pain. Maybe you won't be able to get inflation down without somebody having to forego some consumption or forego something. So it's a very interesting time, but also it's very important that they get this right.
A couple of things I've been thinking about. So one, the character of the fiscal side, the fiscal reaction is as important as the size of it, I think. So you mentioned the transfers during COVID and how those were inflationary. And I don't think there's any debating that handing out money to people without any recourse is going to cause them to spend money, and probably more than they should. And that is inflationary without question. There were other factors also, supply chain stuff, yes, which compounded things. But if you were to literally go out tomorrow and print a whole bunch of money and hand it out on the street, you're going to cause inflation because there'll be more demand for the same amount of stuff. I don't know how that's in any way debatable at all. But what if the fiscal impulse is instead on the supply side? And right now the polls are pretty much tied, but what if whoever the next government is, and I think the Conservatives lean more this way, but honestly we haven't seen anyone's platform yet, so I could be dead wrong. Maybe the Liberals under Carney look a little bit more supply side friendly. But what if it's more tax cuts rather than spending, and they just kind of keep the government spending side more or less in check, and you still have relatively sizable deficits, maybe even bigger than now, but you have a better supply side of things, productivity improves, all that kind of positive stuff happens. That's probably not inflationary. Well, I know it's not inflationary. So that's one side of fiscal that can go right.
I agree. There is probably some efficient frontier on tax policy and productivity. And
we're way past
yeah,
that.
I was going to. I think most would agree there's probably a dead weight loss we could reclaim. So yes, for sure.
Okay, so that's one thing. The other, you talked about the bank potentially hiking and that being a thing that no one is speaking of. And yeah, I mean, obviously, I do think that like Z5, Z6 should be steeper. I've been on that for a long time. As much because like you could see more this year. They're not cutting next year, that's for sure. So the risk is that they hike next year more than that they keep cutting probably. But beyond that, I think so. Like I was having a conversation with one of my colleagues in economics, and he was asking like, what are your thoughts on the neutral rate here, given the population numbers out this morning, which showed materially weaker population growth. And historically, the neutral rate's kind of like some add up of productivity growth and population growth, and the U.S. rate gets lumped in there in some way, shape, or form, and it would move up and down with that. And the strong population growth we've had probably pushed it somewhat higher in the Bank of Canada's mind, and now the population growth is coming off. Maybe it comes down a bit, and I don't know. I'm not sure that it's that simple. I mean, I just kind of try and look at the real world instead of just the theoretical world, and look at the economy and think, okay, well, the bank cut 225 basis points, and let's take out the last cut earlier this month. So they cut 200 beeps to January, and even you could even take out the Jan and take it, say, 175 to the end of the year. How did the economy react to that? The economy came out pretty strong in the back half of the year, and you had growth that was in pretty good shape. You had all the interest rate sensitive sectors come back. You had housing come back. You had auto sales come back. Spending was relatively strong. Consumer spending was in pretty good shape, and like things appeared to be moving in the right direction. And inflation also seemingly bottoming now, as that is somewhat of a lagging indicator. Maybe neutral is a little bit higher than people think. Like maybe 3% is actually like an okay place to be. And it's the higher end of the bank's neutral range, but it's in their range, which is kind of saying something. And like, you don't really necessarily need to be that low. And so that, I mean, it's something to consider when people call for, and I was talking to a client today, and he was like super bearish on the Canadian macro. He's like, how does Canada survive these tariffs? Is this country not going to completely implode? And I was like, well, he's like, how are people not getting fired left, right, and center already? Like no one can survive 25% tariffs on top of whatever their price is. Like that'll just send everyone to bankruptcy. I was like, well, first of all, 1 month is not the end of the world. Everyone can manage for a month. Most can manage for a month. I shouldn't say everybody. There already are some that are impacted, but it's not broad swaths of the economy. And if it stays 25%, yes, people will get hurt, and that will be the case. But it's just not that simple that rates need to immediately go to zero. Like there are enough other considerations, and fiscal being a big one, that can really change things substantially and just make it not as clear that rates should, need, or will go to zero, and that doesn't speak to QE and the other wonderful stupidities that we've done over the past, kind of normalized over the past 20 years, which I don't agree with. And I'm hopeful that policymakers have understood that mistake that they made.
Well, that's part of what's making me a little concerned, is that I don't feel like anybody's ever taken much heat for having
accountability.
9% inflation, right? Whatever it got to in Canada, 7%.
It's my other favorite word.
Yeah, well, that's a good word. and so I think, and this is where I think the Bank of Canada maybe hasn't been transparent enough, and where I don't give them a lot of leeway, which is, okay, so based on everything I hear about output caps, there is some correlation between the overnight interest rate, your own policy rate, and the level of inflation. That's why they use it as a tool to manage inflation. And so if we take the overnight policy rate from 5% to 2.75%, I'm assuming their own model says that's going to increase inflation. And so if the spot inflation is already way above target, what did their model say inflation was going to be outside of those actions? Negative? I mean, zero? Would it have been zero? So let's say if you think the long and variable lead times are 6 to 12 months, what was the 6 month forward in their model on inflation? And it had to have been like zero. So if it turns out that was 2 and they just miscalibrated it, we could be looking at like 4 or 5% inflation again. And so, that would be an enormous policy error if we end up having higher inflation than what is already the target. And I don't know what I would do in that situation. Like, I don't want to make it seem like this is just an obvious, easy thing.
You would cry.
Yeah, exactly. It's a difficult job. But I don't feel like we've had, outside of like the odd a sentence here or there, really much explanation as to why all this cutting was necessary relative to spot inflation. some insight into what they're modeling would have been really helpful. I mean, they have a theoretical, the neutral rate's here, but what's the variation on the potential neutral rate? It's got to be 100 basis points. So anyway, to make a practical point in terms of the trades that we're seeing and how we're positioned for it, even if we start to talk about hikes, which I think we're a really long way, really, really long way away from that. I think everybody expects they're going to cut 2 more times this year. Probably, I think most people think they'll cut in April. And so couple that with what we expect to get on the fiscal side. We like steepening. We have kind of like steepening. We don't think people are that crowded into it. And the example of the inflation print yesterday, when you print nearly 3% in core inflation and the curve steepens, tells us, this isn't all that crowded. People aren't worried about it. So I think that trade has room to run. I feel like
where on the curve? Which?
I think being long twos makes a lot of sense. Twos versus everything else, because what you may end up just getting is CGBs getting annihilated, but people feeling comfortable that the Bank of Canada isn't going to do anything to hurt them, which they have very good reason to think that. And so as a way to kind of absorb some of the supply, you're long twos and you're short CGBs or short 10s or 30s. Where that might go wrong is, if the Bank of Canada doesn't about face, and then you'll have to get out of that, and that will be painful. I don't think there's many people that think that's a possibility. And, of course, those can set up for good trades, but I feel like we're still not in the early innings of the steepening, but I think it's got further to run. The last point I'd make, the Conference Board in the U.S. has a question they ask associated with the consumer confidence report that says, what are your expectations for rates in the coming year, higher or lower? And up until, I haven't checked it in a month or two, but up until, let's say, Jan, such a high amount of people were expecting lower rates in that it was consistent with bottoms, the kind of respondents you would see at major bottoms in interest rates, not major tops. So I just feel like most people here are expecting rates to go back to zero. So if that ends up being wrong, it'll start further out the curve. I think people are going to be comfortable to hang out in the front end, and there's no reason as yet to think the Bank of Canada is going to have to change and turn around and hike rates, because they haven't told you they're worried about the fact that the core inflation has been above their target for 4 years. But I digress.
Do you think they cut in April?
No, I don't. I mean, again, I wouldn't have cut at the last meeting.
Yeah, but
So so I have my own bias.
Do you think they will, not what they should do, what they will do?
I think if we get, again, we're one bad headline. We've just had so many of these headlines. It's crazy. One bad headline about double retaliatory tariffs, and they'll probably cut.
That is, yes. I mean, early April is going to be key for this. I think if we're status quo with where we are right now, I don't think they probably want to cut. I think they'll do their best to not, and hopefully they don't get their hand forced. They kind of didn't really want to in January. They talked about not doing it at this meeting, so they didn't really want to do it again either. And so you already have 50 basis points in your pocket that you maybe didn't want to put in. And so there already is some cushion to all this tariff stuff. And quite frankly, as he said a great many times, there is a limit to what monetary policy can do to fight tariffs. And that is the truth. And so there's only so much they're going to do. And I think they've made it pretty clear. I'm not quite as downbeat on the Bank of Canada as Jeff is. I give them a little bit more credit at the moment. At the moment, I don't like 2020, whatever, that whole inflation period in 2020, 21, 22, most of 23. They did hike first. They did cut a little bit first. I will say their model, their 6 months, 6 month forward would have been quite at 5%. Inflation would have been quite weak by now, and you would have seen that come through. But I think now is the point where they're going to kind of earn their money, I guess. The easy cuts are in, and now it's much harder to make that policy choice to not cut from here, because it's always easier to lower rates and make everybody happy. It's much harder to kind of stand firm and say, hi, you need to take your medicine because inflation is a risk here, a real risk. And until we know that it's not, you're going to keep taking your medicine. That's just the way it goes. Sorry. I know this hurts. It doesn't taste very good. Have a nice day.
One of the reasons I think I might be onto something is I don't know of anyone that's critical of the Bank of Canada. I feel like I'm the only person that has anything, and it's like a caveated, somewhat prickly ill will, because I feel like they're getting too much of a free pass here. In my mind, interest rates are just the equilibrium between savers and borrowers, and we've favored borrowers too long in this society. So maybe I'm the last the last saver who cares about the rate of interest I earn. But I guess I always have questions for you. My question would be, what do you think the Bank of Canada has gotten right? What's right here? Have they assessed the risks facing them adequately? Is there a case that they haven't gone far enough? What am I missing?
They have been aggressive among central banks. Like they tend to be first out of the gate. They were first out of the gate to hike. I think initially they probably underestimated the momentum in inflation, and to some extent, it's hard to blame them in that period coming out of 10 years of no inflation. And you've been trained to believe that inflation's been dead and will be dead forever, and so to some extent, you're kind of a victim of your own success, and so dynamics were pretty challenging in the pandemic. So I don't give them a pass per se, but I understand that it was challenging. So they've gotten the direction right. Maybe they tend to be a bit late in moving, but they're before everybody else. So for whatever that's worth, relative game instead of absolute. And the rate cuts that they put in the back half of last year were appropriate up to a point. And now the question is like, well, where's the economy going from here? And I can't answer that better than anybody else, despite the fact that that's literally what I do for a living, because I don't know what will happen in early April. I suspect this kind of doesn't get to the heights of pain for Canada and we get completely destroyed. That's just my bias, because I don't see how that's in anybody's interest, including the U.S.'s interest. But that doesn't mean I'm going to be right. And if things are bad enough, then they probably cut a bit more. But I turned very bullish on the Canadian economy at the turn of the year, seeing the data. It was clear to me that things were going the right way, and you didn't need to cut down to 2%, which people were talking about before the tariffs. That was not at all my view. I know we as an institution were a little more dovish than my view, which was fine, but I turned very bullish for a reason, because rates matter a lot. And when you cut them 200 basis points, it should make a difference, and it did. But now we have this problem. So the bank, I think they've done a good job. I think now is the test for them. From my perspective, I think April, if there are no tariffs and they cut, I would say that's a mistake. If there's no escalation in April and they cut, that's a mistake. But I don't think they will cut. I think they will stand firm, assuming things don't get a lot worse. If there's way more tariffs, then I think they don't really have a choice. And then maybe you get a little bit of a quicker response for them, and then maybe they come down for a little bit and get down to 2 or something in that ballpark, or 2.25 or 175, somewhere around there. But then they bring them back up a little bit quicker once they see that you get fiscal coming in and things are stabilizing. Maybe they bring rates back up to neutral a little bit quicker, knowing that you have this fiscal coming and it's going to be a wave and it's going to push things. I don't know if they have the will to do that, because again, it's not going to be very popular. Are they willing to take away the classic central bank line? Are they willing to take the punch away just as the party's getting started?
One final point. The only thing data-wise that's keeping me up a little bit in Canada is the condo market in Toronto. I think actually the housing market in Canada is fine. Single detached homes are fine. They're balanced. We went from a very, very tight inventory to not so much. But the condo market in Toronto looks a little heavy to me, and I don't know what that could end up meaning. But that is, if I'm wrong, that's the one thing where I look and think that is not inflationary. There just seems to be supply, nothing's moving. A lot, we know a lot was built 5 years ago, is coming online this year. How that reacts will probably be the linchpin, I think. If the buyers end up showing up, and again, it's difficult to say we had a housing shortage for 20 years and now all of a sudden...
Did we though? Or were rates just too low for a large swath of that time, which drove excess demand, and the demand wasn't really there, despite everybody yelling at the top of their lungs that we weren't building enough houses?
Well, then that's going to get really interesting, because then inflation maybe doesn't come down, even though that part of the market needs lower rates. As always, there's one interest rate for the economy, but every little sector has its own need. So anyway, that's something I'm kind of watching with a bit of interest.
Should be. That is a serious problem for the city. I think it's really just the city of Toronto problem. There will be an excess supply of condos. So as I've laid it out a bunch of times, I think probably on here, that the way I look at it, you have prices, rates, and rents, and they all need to line up. And they don't. Rates are too high relative to where prices are to carry the mortgage at the rent. Simple as that. And there's no reason for anyone to buy these places when they can rent them for less, because again, rates are too high. Or rent, like it's all the same trade at the end of the day. It's like it's just a triangle, and something's got to give. And it doesn't look like rates are going to give anymore. Prices are coming down. I think that's probably the most likely one. The problem is rents are also coming down, which is the opposite of what you need for that to balance out. So it's probably going to be a tough period, I think, for condos in Toronto for a while. I just, given the population trends and slowing population growth, like it will be hard. And I don't see any easy way out. And again, all of that yelling about building stuff was just misplaced. And the rush to build all of these buildings as quickly as you possibly could. Oh, now that they're finished, we have a problem. Who would have predicted that? I mean, isn't that what always happens? That you rush to find a solution to a problem that may or may not be there, and that, I mean, then you create a different problem. And so, like, I mean, me and Robert Kafsick, and he yells louder than I do about this. Like, low rates were the driver of this. Like, there was a demand push problem. It was like supply was not the issue. It was demand. One, we let in a zillion people over a very short amount of time and really juiced demand. And really that pushed up rents and all that kind of stuff. And then it looked like there was a housing shortage, but rates were also low for 10 years. And all people did was flip houses and bid up houses as often as they could without any concern as to whether it was worth it or not. All they could think about was whether they could carry the mortgage. Great, I can carry it. Mine. Oh, I'll sell it to you. You're like, just keep going. And like, one, it's bad for productivity, but that's a totally different conversation. But like, this is the reckoning of all of that. Consequences. Back to consequences.
I have a friend, I know we're running short of time here, who works in wealth management. And he tells me in Canada, you build a small business from nothing. You sell it down the road for $10 million. Only the first $1 million is tax exempt. You buy a house for $1 million, sell it for $6 million, as many have here. The whole $5 million gain is tax exempt. That's, to me, is a misallocation of resources. Okay, so as we approach, maybe we'll agree to sit down again in 6 months and see how the bank did. Question, though, I'll leave it with you. We're closing 10-year yields in Canada around 3%, plus or minus 50. What's the next move? Yeah, I'll take
higher.
I'll take plus as well.
3%, we've had trouble cracking 3% on any consistent basis in tense. And like that just tells you that there's just not a lot of value there. I think it's hard to find buyers at these levels on a consistent basis. And I do think something will come on the defense spending side, on the fiscal side. And it's almost no matter who wins, I think we get more defense, which means more spending, which means more issuance. And then we'll see what happens on the stimulus side, if it's taxes or spending or whatever else it is. So we'll have to wait and see on that. I agree with you on the steepening. Otherwise, strategies, and we like selling Canada to the U.S. in tens. I know you guys like the same, and Canada Desk also likes that trade. I think it works both on the Canada leg. It actually probably works better on the U.S. leg. I think tariffs are just so bad for the U.S. at the end of the day. Like, there's nothing's going to stop the Fed from having to cut sooner than people think, and maybe a little bit more. And that's going to richen up the U.S. And yeah,
I agree. And I think the market will need to see the announcement. I think you're really going to have to wait. Right now, the flows are still just such the way that there just is an underlying bid to CGBs relative to treasuries that I really feel like will fade if we get a big something.
If we get something like Germany, it's going to be a destruction in Canada.
If we don't get that, we'll have to revisit. But I still think you could see 3.5% before 2.5%.
Yep, I'm with you.
Great,
Jeff. Thanks for coming on.
Thanks, Ben. It was great.
Thanks for listening to Views from the North, a Canadian rates and macro podcast. I hope you'll join me again for another episode.
The views expressed here are those of the participants and not those of BMO Capital Markets, its affiliates, or subsidiaries. For full legal disclosure, visit bmocm.com/macrohorizons/legal.